Welcome into America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates. Securities offered through Peak Brokerage Services, LLC. Advisory services offered through the Retirement Guys Formula. Registered investment advisor. America's Retirement Headquarters, America's Medicare Associates, and the Retirement Guys Formula are separate and independent entities from Peak Brokerage Services, LLC.
Hope you're having a great day out there. We want to thank you so much for joining us and spending part of that day here with us on America's Retirement Headquarters, the home of America's Medicare Associates and the Retirement Guys Formula with Nolan Baker and Dave Ross and myself. My name is Chris Swan. 419-794-3030 is the phone number. It's 419-794-3030. Online, arhq.com. Today on the show, why more people are talking about and asking about guaranteed income in retirement. If your heart's set on retiring early, we'll tell you what you first need to know and find out the difference between an informed and an uninformed taxpayer. All this and more, but first, let me check in with the guys. Nolan, Dave, glad to be with you. How are you doing today?
Doing wonderful. I just want to wish all our veterans that are out there and those men and women that sacrificed their lives happy Memorial Day. So hopefully everybody is out. It's right here in Northwest Ohio, it's kind of like the kickoff, I think, of summer season is what I think of. So I think it's, get the camper out, get the boat out, get the outdoor stuff ready to go. And hopefully everybody has a wonderful and safe Memorial Day weekend. And again, thank you to all those that are serving our great country.
Definitely want to thank all those out there who are serving, those who made the ultimate sacrifice, keeping them in our memories. That's what it's all about. It is the unofficial kickoff of summer. A lot of graduations and things of the like going on. Summer plans, vacations. You may be planning a summer vacation. How much have you planned for the ultimate vacation in retirement? That's what we want to get you thinking about and preparing for it. And I think this leads us right into the first question here. How much have America's richest saved for retirement? Honestly, probably less than you think. According to a new survey, the top 10% of households by net worth had an average of $1.29 million in their retirement accounts. Now, you might out there, be listening saying, I don't have nearly that much. You might have $500,000 and you're going to be just fine. But someone who saved $5 million might be in trouble. It really depends on person to person. Have you ever had a client come in who looked great on paper, but it was their spending that had them headed towards trouble?
Yeah, that is one of the challenges is, what is a safe withdrawal rate in retirement time? And, spending money can be somewhat of a challenge. I was kind of surprised, Dave, when I saw the number and it said the top 10% of households by net worth had an average of $1.29 million in their retirement accounts. When I was thinking the top 10% by households, I would have thought that balance would have been quite a bit bigger. No matter the size that you have, again, whether you have 500,000 or 5 million, how you take money out of that account can dramatically impact what's going to be the long-term success of that. In fact, during the show, we're going to talk about other type of risks that are associated that can have a negative impact for those of you that are transitioning into retirement time, like sequence of return risk. But, when I look at it, the most common cited safe withdrawal rate is 4%. And that 4% rule, it kind of originates back in 1994, which was a study that was done by a financial planner who found out that withdrawing 4% of the retirement portfolio in like a 60% equities and 40% bond type portfolio adjusted for inflation would typically allow the portfolio to last for 30 years. A couple of things, though, when I think about how people run through their money a little bit quicker in excess spending is one of the things is, planning for the healthcare in the three different phases that you have for healthcare. That healthcare phase, if you're going to retire before the age 65, identifying how to, get through the navigation of the Affordable Health Care Act, because it's an income, not an asset test when you end up drawing benefits and say age 62 retire and you're going to collect from affordable health care. How you position where you take money from in that time frame can make an impact. Your Medicare premiums can be impacted by things like, say, paying off the mortgage or taking extra withdrawals from the account. And then way down the road, if we think about excess spending, overwhelming majority of the time, that excess spending comes from people needing some type of long-term care. The other thing that I would say in my 30 years of experience, when I think about excess spending, people have this big bucket of money, right? The money they can finally access for retirement time. And so what they do is they will sometimes make some decisions to go out and, take on a lot of debt at retirement time. Maybe that's the desire to have a dream home down in Florida and have a place that you could go and get away in winter, or maybe it's to change and swap out the house that you have now with something bigger and better for the next phase of your life. But taking on a lot of debt in retirement time, or quite frankly, taking on any debt in retirement time, is something that I would generally argue against doing. If you're going to transition into retirement time, sure, who doesn't want to go to Florida when it gets a little cold here in Northwest Ohio? But maybe for the first couple of years, you do an Airbnb and rent out a place for a couple of months, a couple of weeks, kind of test drive that before you get pot committed, to having some type of major expense inside of there. The third is, I would say it's important to make sure that you're covering your reliable income sources with things that are predictable income. That's going to be your Social Security, your pension, your annuity income. When you look at your needs, now I'm talking needs, not wants. When you look at your needs, you want to have that covered in reliable income sources. The excess money that you have, or the growth part of the portfolio, that money can go into the stock market. And when you have excess growth, when the market exceeds what your desired outcome is, maybe those are the years that you spend a little bit more, get the roof fixed, put that new deck that you wanted on the back, take that extra vacation or the one you've always dreamed about, spend it when you have those excess years. But you do have to be careful, because at the end of the day, I tell people, look, it's your money. You can spend it however you want, but it's got to last you forever. I don't know, when you talk to retirees, Dave, what are you telling them about, what is a safe withdrawal rate in retirement?
3.5% to 4%. I am a longtime believer in that 4% rule. The problem that I see happening with a lot of retirees is that when they plan for a purchase, it could be a car, it could be a roof for their house, it could be a vacation. If they're taking that money from the same IRA they're drawing income from, that can really throw a monkey wrench into the long-term viability of the portfolio. So, in a perfect world, it'd be nice if everyone had a discretionary spending account that wasn't in a retirement plan, where you had hopefully hundreds of thousands of dollars sitting in an account that if you want to buy something, you can buy it and pay cash, so you don't have to take on debt. But when you take excessive withdrawals, if you're drawing 4%, and then all of a sudden, the client calls up and says, I need $20,000 because I need to put a new roof on the house. That really can stress those numbers quite quickly. And it seems like a lot of times when we mention to people how much money they can draw, that number seems to go up.
It really does. You might start out with, say, $2,000 a month, and maybe that falls into that 3.5% or 4% range. But when you start tapping your retirement account for $30,000 for a car, or $20,000 for a roof, or $10,000 for a vacation, you've got to add that in addition to the $2,000 a month, because that's really what your total withdrawal rate is. So if you're worried about your withdrawal rate, if you're worried about what is the strategy to take out the best amount of money for your retirement, to have confidence in our retirement team action plan, we can stress test the scenarios and run 3,000 possible outcomes to show you, what could be a safe withdrawal rate for your retirement. So if you're not sure, let us know. We can run that retirement team action plan and help you crunch the numbers.
It's easy as reaching out and giving a call to the team, 419-794-3030. Once again, that's 419-794-3030, or going to the website arhq.com. Nolan, you may have seen me scratching down on this pad of paper here very ferociously. The 4% rule, the 4% withdrawal plan, this was implemented in 1994, as you mentioned. You also mentioned that you have 30 years in the industry, which means that you were starting out when this 4% rule was a pretty much a brand new, fresh idea. What was your stance on it then when it was this new idea, and has that changed over the past 30 years?
Well, I've looked at this 4% rule, and, I would say conceptually, I would agree that the 4% rule makes a ton of sense. What is a little bit different today than in the past is, the 60-40 mix when you had a lot of money in bonds. The challenge I saw of the 4% rule a couple of years ago is, you had a large part of the portfolio that was in kind of a dead asset class because of where yields were, where interest rates were, and that interest rate risk that we had talked about here on the show. Now, what's changed today is if we look at where interest rates are significantly higher here in 2024. Maybe not using bonds, but some other traditional fixed accounts, whether it's a CD, a fixed annuity, or an indexed annuity. When you look at how that runs in a stress test scenario, it makes it a lot stronger. So it's important to make sure that you're learning about rules that were written 30 years ago, but applying today's economy to your portfolio to make sure that you're keeping up with the times, because, there are opportunities in today's environment to make sure that you're locking in some higher rates to help solidify that 4% withdrawal rate.
It's okay to know that your opinions on it may have changed, and it may change over the course of your retirement. And also knowing that these rules of thumb, they are not ironclad. 4% may actually be the right withdrawal rate for you. It may be a little bit more. It may be a little bit less. It really depends on your particular circumstances. And to find that out, again, America's retirement headquarters is as easy as reaching out 419-794-3030. Schedule a time to speak with them, that retirement team action plan, or go to the website, and that's arhq.com. A big question that the nation has going into the tail end of this year: who's going to be president? The Federal Reserve is trying to balance inflation, the stock market, and public opinion when deciding when and how to move interest rates, and the whole election. Here's Chris Zaccarelli of the Independent Investor Alliance recently on Fox Business.
Our best guess is that if they do cut rates one time this year and not zero, they may do it in December and just wait till after the election. The last thing they want to do is threaten the appearance of their independence, despite the fact that they maintain they don't think about the election at all, which as human beings, I think is hard to believe, because clearly everyone is thinking about it.
It is on the forefront of a lot of people's minds. I mean, we're talking about right here. Dave, Nolan, how are you guys advising clients heading into this election year?
Well, if you follow historical perspectives, election years are great years to be in the investment markets. In fact, I've read where, regardless of whether a Republican or a Democrat is elected into the presidency, that average returns during an election year are 11%. Now, in my experience this year, a lot of my people are throwing caution into the wind because they think that this election coming up is going to be unlike any of the other elections that they've experienced in their life. And they could very well be right, but do you get out of the market because it's an election year? That's probably not a wise perspective. Do you go to low risk, low return options because you're not sure of how this market's going to behave? You can get 5% with low to moderate risk. A lot depends on where you stand in terms of having the money that you need for retirement, or if you're in retirement, how your spending is matching up with the growth of your money. So it's my money. I'm going to keep some in play because I think that this year could be just like every other election year and be good for the markets. I think the Fed waiting to cut rates, that kind of makes sense to me because they don't want to influence votes one way or the other because of their decision-making process. But that's why having a diversified, well-balanced portfolio covering multiple asset classes is very, very important. So the election itself shouldn't have a great impact, but it will have an impact, either positive or negative, or maybe flat. So that's my take on it.
Yeah, we covered this in our economic summit. That was the event that we had a couple of months ago where we talked about how to get prepared for the election year. And as Dave pointed out, oftentimes in an election year, the market has pretty strong positive results. Here it is, the end of May, and the market has had pretty strong positive results this year. What I would tell people is, I heard, people that mentioned to you that, this time, being it's going to be different. Whenever I hear somebody say it's going to be different this time, that really makes me very nervous. I have heard a couple of people that say, hey, I just want to get out of the market and wait on the sidelines until things get better. I heard people when Biden got elected that they were going to get out of the market. That first year of the Biden presidency, the market was quite a bit higher. If we look at things, in the longer term over the last couple of years, the market is significantly higher than where it is. So instead of focusing on how to invest in the election year, just realize that that's one more reason to not be invested. The basics of investing, in my opinion, are pretty simple. You buy low and you sell high. The market is at record highs right now. Instead of worrying about getting in and out of the market, what you want to do at this point in time is just to implement a downside risk management system, especially if you're close to or in retirement time. Now, what that could mean in your situation is that could mean taking some of the gains that you have out of the market, moving it over to something that is non-market risk. We can utilize strategies that provide circuit breakers within the market. So ask yourself, if the market does go down and your gut feeling is right and the market does really go down, what will your current investment team do to help protect you from significant losses? And if, the answer is write it out or nothing, then I think that's really why you want to talk to us about our methodology and, what we call the independent income system, because with that approach, we can help give you better crystal clarity in telling you how to invest in your portfolio. So we, at America's Retirement Headquarters, we focus on that, and that's why it's important to have downside risk management if you are close to or in retirement time. But the other couple of tips that I would tell you is, number one is if you're younger, if it's 10 plus years, don't even worry about the election. Turn off the news, turn on the travel channel, focus on the long term. Over the long term, staying invested has proven time and time again to be one of the best approaches for a long-term investor. If you are worried a little bit about election years, we could selectively help you kind of pick things out. You could consider how to position your portfolio. As an example, defensive stocks, things like consumer staples or dividend-paying stocks might be a little bit more attractive. A lot of times coming out of the election, you think about value versus growth. Value tends to outperform post-election. Pay attention a little bit to how each proposed candidate, might impact different sectors or what industries to be in if you really kind of wanted to get involved in that. But try to avoid that market timing with your gut, thinking again, this time it's different and I'm just going to get out. But while the market is at an all-time high, again, prepare for market volatility. If it's not the election, it could be something that's a crisis overseas. It could be something else that's happened. Just know that while the market's at an all-time high, is a good time to be running the fire safety drill with your portfolio. If you have not run the fire safety drill with your portfolio, I realize the weather's getting nice outside, but at least invest an hour to get together with us, get our retirement team action plan. We'll show you how to kind of have a downside risk management program put in place in your portfolio so you can get back outside, not have to worry about short-term, the news on what happens with the elections or the markets.
Actually, a little nugget of truth to the phrase, this time it'll be different. It is 4 years further along than the last election, so we're all a little older, hopefully a little wiser and closer to retirement. You might now need to be in the retirement, or you might now be in the retirement red zone, and so you need to be more proactive about it and to have maybe your risk readjusted. This is a great time to take a look, have that second opinion run, take a look at the independent income system by going online. You can just search for it in Google. You can also go to the website, find out more about the independent income system, and schedule a time to speak with the team at America's Retirement Headquarters, and that is at arhq.com. Now, last year, Americans held about $21 trillion in IRAs and 401k retirement accounts. That is up about 20% just from the year prior to that. A lot of that money is being held by the older American sector, and an article from AARP says that the financial services industry is now bending over backwards to serve them, especially when it comes to guaranteed income. Let's talk about that. Some examples of what your clients are talking about and what they're asking for.
Well, I would say that I think any person that's in retirement time or close to retirement, one of their biggest goals is not outliving their income. I mean, that fear of running out of money is a real deal. I mean, Who wants to go back to work after you've been retired for quite some time? So it does make sense to me that guaranteed income is important. Plus, you add on top of that with the record level high interest rates, things like FDIC insured CD accounts, money market accounts, and annuity rates are very attractive. We have a lot of segments that we talk about this in our philosophy of how to build it out. So, from a visual perspective, if you would like to take a look at, how do you position that reliable income into the portfolio versus your variable stock market, just go on Google and type in independent income system. If you type in independent income system, we've got a 15-minute video that kind of walks you through what that approach is. What I would say is, when somebody's asking what is the best investment for retirement, the one thing I would say is there's no Swiss Army knife product. There's a lot of things that you'll see on TV that says nobody should own annuities. There's a lot of financial professionals that say you should put all of your money in annuities. There's no one right product that's right for every situation. One of the things that is nice about having guaranteed income is it can kind of reduce the volatility in your portfolio, reduce your risk level, but with safety comes, either less growth, that could be some cases no growth if you're just living off the income produced by that. Sometimes, there's different time frame commitments where you have less liquidity. Again, in building this out and figuring out how to put it all together, the approach that I recommend for folks is called the independent income system.
I think it makes a lot of sense that when we have discussions with people that we identify what their basic needs for housing, automobiles, insurance, cars, all of that, the basic expenses of their daily life, and knowing that those expenses are covered. Because I can't even imagine what it would be like being retired and saying, gee, I don't know where I'm going to come up with the money to pay my mortgage in a couple months. So you want to make sure that you use the guaranteed income portion of your portfolio to cover your basic expenses. And hopefully you'll have other funds in your retirement accounts that you can leave for either an inflation hedge or to make purchases that you're going to need to make over the course of your retired life. So having identified buckets that are going to give you needed monies when you need them for the right reasons, that's critical, and that's why I think the independent income system makes a lot of sense.
And, what I would say is there's a lot of people that are probably listening today that already have, FDIC insured CDs. Maybe you have a money market account, a large balance at your checking and savings that's not, subject to market risk, or maybe even purchased annuity a couple of years ago. It's been my experience, though, that the people that we're meeting with right now, there's so many great opportunities out there based upon where current rates are to be able to take a look at kind of upgrading your situation. Number one, for those of you who have a large balance in your checking and savings, it's pretty common when you come into the office and I talk about, where some of the rates that are out there, it's able to, take that money market rate and get up to a 5% rate based upon where the rates are today in this environment. Even FDIC insured, I had met with a couple just last week. She had bought a CD a couple of years ago. And a couple of years ago, when CD rates were so much lower, she had locked in a lower rate. And she was just going to wait until the CD matured. And then hopefully the rates in 2 years from now when it matured would be higher. The reality is if you looked at that CD and looked at the low interest rate she was getting, it was less than 2%. She could pay a small penalty to the bank, take that CD out, put it into a new higher interest rate CD, and in a very short amount of time, with the higher the interest rate was today, be able to lock in a much higher interest rate while we still have rates that are at record level highs. It's possible in 2 years from now, if she waits, that rates could be back down. The Federal Reserve has indicated their plan is to lower rates. So by locking in some of the higher rates today, could be a good option. But when you're looking at it and you're trying to figure out, what is the best investment for retirement, or do I have the right investments for retirement? The biggest people that are at risk are the people that, are within 5 years of retirement time or just transitioning into retirement time, and they are keeping the same investment allocation that they had when they were in their working years and still had a 10 or 15 or 20 years to go. So the way we can help with that, again, is that retirement team action plan. We can do the analysis for you, help you figure out what your asset allocation is. And in the meantime, if you want, just Google the independent income system, and you can get more information on what that approach looks like that we offer here at America's Retirement Headquarters.
In the same way that you probably don't drive the same car that you had when you first set out in the working world, the vehicles that you use to get you through retirement and even leading up to retirement, probably going to look a little bit different. And so to find out how to do that, how to get those components of guaranteed income beyond Social Security, perhaps if you've got the luxury of a pension, maybe using some guaranteed income products, thanks to the high interest rates, it's as simple as reaching out to America's Retirement Headquarters and finding more about the independent income system and the team action plan. You can go to arhq.com or give a call. The phone number is 419-794-3030. Earlier in the show, we were talking about this being the unofficial kickoff of summer. A lot of people are vacation-minded, and people looking for a more budget-minded yet carefree vacation may want to consider heading to an all-inclusive resort. You know, you pay one price, enjoy unlimited food, drink, and most amenities for the duration of your stay. I did one earlier this year. It was delightful. But a travel writer for Business Insider says first-timers often make the same mistakes, like not researching before they book, not realizing they could upgrade to a suite with better perks, and not making dinner reservations extra early. That one bit me in particular. People shopping for a financial advisor for the first time, they could also make mistakes. What are some of the ones that you've seen?
You know, in reading over this article, I think there is some good pointers here. If you're listening and you've never worked with a financial advisor, it's important, I think, to understand the different types of advisors that are out there. Number one, I would say, is you have insurance salespeople. And I have an insurance license. I know, Dave, you do. Many people do at the office here, and there's certainly a need for insurance. But when somebody's only insurance license, all roads lead to insurance, and it's, you know, difficult to hold yourself out to the public as a financial advisor when you just have an insurance license. The second type of person that you have is you have some people that are what are called commission-based salespeople. And this topic has become more important here recently in the last couple of years as people talk about, you know, does your advisor have a fiduciary interest in doing what's best for you? There's some great financial salespeople that are out there. They get paid a commission. They help you set up a product and, you know, get paid for that type of transaction. To me, the challenge has always been in that scenario. If they get paid up front day number one, you know, what's the incentive for things to happen after the fact? The third type of category is somebody that works in a capacity that has a more of a consulting type relationship. That's the relationship that we work with. When we develop a client relationship, what we want to do is really kind of do a comprehensive review of their entire financial picture. And then what we can do is then bring in some of the key professionals. So when we're looking at things like how to navigate the healthcare environment, we bring Scott in, and Scott can help them figure out Medicare and supplement. Or, you know, when we're looking at taxes, either working with their accountant or CPA or introducing them to, you know, one of the relationships that we have. I can think of countless people that we've worked with their attorney or made an introduction to a estate planning attorney to get their wills or power of attorney kind of put in place. A couple of the mistakes I'd say is maybe, hiring the first advisor you meet with. It's okay, you know, if this is something that you want to do, is shop around, look at the difference of advisor. I know my area of specialty tends to be working with somebody that's, you know, right at that transition point for retirement. That's kind of what I've tended to focus on. You know, people that are younger, that are getting started in life. There are some other advisors that I know that do a great job with that program. So you want to understand kind of what the specialty of that advisor is. You want to ask about what the credentials are of the advisor. I tell people to make sure that you understand what the methodology and the philosophy is. I'll ask that question a lot and try to, you know, help people explain to me what their current investment approach is. And a lot of times people don't understand what their current investment approach is. They don't understand the methodology. And to me, that kind of scares me a little bit, because if and when things get tough, and in the market they will, the person who doesn't understand their investment methodology and philosophy would be the type of investor that can be more impacted by emotional decisions. But when you know the exact process that went into picking the investments and the holdings that you have, if some of those holdings are temporary down, then the question becomes, if I believe in those companies in the long run, what do I do to try to add more into the portfolio? So choosing an advisor and helping, somebody pick the right advisor, there's a lot that goes into it. A couple other pointers. If you were at a point where you have a financial advisor and you're thinking, maybe it's time for a second opinion, it probably is time for a second opinion. If you're at work and you've been just doing the grind for all these years, but retirement's right around the corner, maybe you're getting ready to retire. I know as we move into the end of school, a lot of teachers may be thinking about enjoying the summer and maybe making that more of a permanent decision for the long run. Getting a financial advisor, if you haven't, a couple other pointers is to ask for 5 references. You can get a couple references that are clients, maybe a couple professional references. Don't just get the references, call those references. Ask those references more so about what is the experience working with that team. How often are they communicating with you? What does that relationship look like? What do you love best about that relationship? You want to ask the professional, like how they get paid for their services. I mean, nobody works for free. Our firm doesn't either. And if they're not charging fees, they must be making money from the sale of products. And again, that's not necessarily bad, but you want to understand, how things work. And this is your money. So those fees and expenses are important to find out. Ask if they can provide products as well as the financial planning. That if they say yes isn't necessarily a bad thing, but it does present, potential conflict of interest. If the professional does sell some of the products, ask if those products can be obtained if no plan is prepared. I've gone to hundreds of meetings over the years with other financial professionals, and I've been blessed to see, other offices kind of open up their doors to show us, how they run their business in different towns. And it absolutely amazes me when I run into these financial professionals that, by the time they have a cup of coffee and a 5-minute conversation, that they already have investment advice ready to give without really doing plan. When we do things, what we do is we take things slow. That first meeting really is really all about finding out about what's important to you, your goals and objectives. From then, what we do is we write up a retirement team action plan. And that retirement team action plan is something it's unique that's offered here at America's Retirement Headquarters. And as you talked about, we do have a team where we can work on that together, but the team also stands for taxes, estate planning, asset protection, and money management. It's that comprehensive approach of being able to put it all together. And those are the reasons why, when you're going to take a look at a professional, you really want to get it right. And choosing the right professional can make a big, big difference in the long-term success of your plan. We'd love an opportunity to talk to you. Love an opportunity to sit down and put that retirement team action plan together for you.
And a way to start that relationship and continue that relationship, because if we're talking getting you to, through, and beyond retirement, 20, 30 years, that is going to be a relationship, an ongoing relationship. So you want to make sure that you guys gel, that you guys have a good feel for each other. I'm going to go and plug the podcast again, another way to get a good feel for the team at America's Retirement Headquarters, all those previous episodes. You can also attend an upcoming event. You click on the events tab at arhq.com, find out more about those. Or if you just want to go ahead and sit down and speak with them directly for one of those second opinions, find out more about the retirement team action plan, or just, get started. It's as easy as reaching out, 419-794-3030. How many times have you heard the phrase, you only live once? Apparently that mindset, which regained some prominence during the pandemic, is driving more Americans than ever to make their retirement target age 62. Maybe that's why a recent survey by the Federal Reserve found that only 46% of people plan to work past 62. So if someone comes in with that mindset, they're married to the idea of retiring before 62 or at 62, what should they know?
Well, when you look at the word you only live once, or YOLO, I think as the kids say it nowadays, the first thing I would say, caution, right? I think back in, my younger days when I heard somebody say you only live once, not every time good things happened after that. People made some poor decisions. And in this particular case, you're talking about people making the decision to retire early. Being a numbers nerd, I would say, yes, you do want to get up every single day and make the most of every day possible. And you want to be in a position to be able to retire early. But, You also had to think that this retirement needs to last the rest of your lifetime. So if you got together with somebody before you retired and you found out that maybe you need to work another year or two, or, maybe your withdrawal rate wasn't, what you thought it was, it's so much better than YOLO and you only live once and come in and, meeting with a professional after you're already retired. One of the things that we're going to do for you is we're going to help you figure out how much money is needed to retire early. We can actually break it down to you in an actual dollar figure. So if you're wondering, do I have enough? We can help you answer that question. And here's how we're going to do it is we're going to put together the retirement team action plan. And what that retirement team action plan is it's going to go over your taxes, your estate planning, your asset protection, and your money management. What we're going to do is we're going to take those numbers and we're going to stress test the probability of success. We're going to look at 3,000 possible combinations of scenarios that could happen. Like, what if healthcare costs go up? What if tax rates go up? What if Social Security decreases by 20%? What if the market crashes next year? And what we're looking for is we're looking for the probability of success to be over 90%. And if it's not over 90%, what we're going to do is we're going to have a conversation about, what are the steps to take to get it to be over 90%? That could be working longer, but it could be, reallocating your investments to make them work a little bit harder. In this scenario, if you're like a lot of the people that plan on retiring at the age of 62, you need to understand that healthcare costs pre-65 can be much more expensive without proper planning. So if you are going to retire early, you want to get together with somebody who understands how to navigate the cost of affordable healthcare, because it's an income, not an asset test. The third category is you want to understand what is considered to be safe withdrawal rates. Now, if you haven't subscribed to our YouTube channel, I encourage you to go over there. Just type in America's Retirement Headquarters on YouTube. We've got some great articles that talk about safe withdrawal rates, or talking about, how to retire early. I know recently it's been one of our most popular topics. So there's a lot of people, I think, with summer coming here looking to retire early. But at the end of the day, if there's one thing that you're going to want to do, if you're going to want to retire early and or in the next year, invest a little bit of time early into getting that retirement team action plan. If you call the office, we can do the retirement team action plan and kind of put that together. That's probably a common question you get for folks as well, as they're asking you, Dave, about, how much money do I need to retire early, or how do I put it all together? When you give them advice and walk them through that process, what's that look like?
Well, the thing I would try to emphasize is that with people that come in to visit with me, I want to give them an impartial, non-judgmental number that they can count on. And you know what? If they can live with that number, then they might be in pretty good shape. But if they don't, if they say, oh, I don't know if I can make that happen, then you have to look at things like, should you increase your savings rate? Should you work a little bit longer? Should you look to save on your health care in a responsible way where you're not putting more stress on what could happen financially if you have a health condition where you're not going to have coverage? So being able to come up with a number that they can count on, that's number one. And then it's just kind of how you react to it as an advisor, and then give them advice that is meaningful to help their current situation and how to improve it.
Rather than going through the working world and into retirement with the mindset of you only live once, I think perhaps the better mindset for a lot of people is you only retire once. That is the goal. You're only going to retire once for the first time, certainly. Why not turn to a team that has a combined 75 plus years of experience getting people to, through, and beyond retirement? Find out what that is. Maybe not necessarily be married to that number of 62 is when I'm going to retire, but to know when it is going to be a retirement that you get to enjoy and hopefully avoid unretiring. Maybe that is involve working a little longer. Maybe that does involve putting a little bit more work or sweat equity into it. Maybe you find out that your numbers are okay and you can go ahead and retire as soon as possible, or at 62 when you do plan, but you don't know until you sit down and you speak with a team like the team at America's Retirement Headquarters. Here's how you get started. 419-794-3030 is the phone number, or you can go to the website and schedule a time there at arhq.com. Now, the saying goes, I even mentioned it earlier, being older and wiser. What things have you learned as you've gotten older? Comedian Dan Regan weighed in recently on TikTok.
My arm must be in a certain position before I go to bed, so I'll have full use of it the next day. Grumpy Old Men isn't a movie, it's a training video. The excitement I had going to a party as a teenager is the same excitement I have now when a party is canceled. My wife and I now drive by gas stations and announce the prices to each other. I understand now why my grandparents ate dinner at 4:30 p.m. and were in bed by 8 p.m. And they were right this whole time. The music is too loud. And the last one, mandatory bed rest, now sounds awesome.
And the list goes on for those heading into retirement as they discover that unpredictability, well, it is just a part of life. What are some of the most common risks that you guys can help guard against?
I would say that when I think about this topic, an old phrase comes to mind where it says, the more things change, the more they stay the same. And you know what? When you're working and you're earning and you're raising a family, there's unpredictability of expenses, there's unpredictability of health, there's unpredictability of employment. And guess what? In retired life, those same risks are still there. But there are certain things that can happen that if you're not properly positioned, it can have a permanent impact on your ability to maintain your standard of living. So that's kind of why it's very important that you have your basic needs covered. So the risks that we face don't necessarily change. In fact, I would say as an older person, health could be the number one risk that you're faced with, because if you get sick and you end up having to spend a lot of your retirement savings to take care of your health, that could have a real negative impact on your ability to live your retirement the way that you want to. And then there's some people like myself who are 65 years old and have 3 kids in college. So early retirement was never an option for me. I've got to keep working, and there's more and more people that are looking to work longer, and I'm certainly one of them.
One of the things that I love doing is, what we call the retirement team action plan. And, putting that together, we write out for clients what our summary of observations are in their situation, looking at ways to help them better manage their money or protect their assets or plan their estate. And sharing those observations, where to take it up a notch and or eliminate threats that they haven't thought about. Some of the most common risks that we can help guard people against, really 6 that I put on the list here. Number 1 is sequence of return risk. The sequence of return risk is for those of you that have transitioned into retirement time and not made a change to the asset allocation in your portfolio, and or maybe you're just in a target date fund, but still all of your money's at risk in the market. So if you have a major market downturn in those early years of retirement, it can be a disaster. A solution to that is what we call the independent income system. Number 2 is a premature death of a spouse and the loss of income. So we think of life insurance, and we think of life insurance when we think of young families and kids, but life insurance still is very applicable for a retiree for the replacement of a loss of Social Security. Number 3 is longevity risk. A lot of people will spend their money and they'll spend it aggressively, and we talk to them about the safe withdrawal rate, and they say, well, I'm not going to live past 75 because nobody in my family ever did. Well, the reality is what happens when you're sitting at 76 across the table from us and you've spent through your money too fast. Having the longevity risk and delegating some of that risk to the insurance companies of America makes a lot of sense for a lot of retirees. Factoring in inflation, it's the real deal, and making sure that your plan is inflation adjusted. Developing a plan for, as what you talked about, long-term care cost. You can have your family's life savings wiped out, when it's $10,000 a month of needing long-term care. And number 6, to wrap this segment up, is talking about spending shocks. Something's going to happen in your life that's going to shock the system, whether it's the kids need bailed out, the basement flooded, the car unexpectedly needs replaced. Having that emergency account set aside for spending shocks is another great thing to do to help eliminate some of the risk in those areas that are common retirement risk for you.
Having a plan with the team at America's Retirement Headquarters really comes into play to get started, to start developing that to guard against these risks. 419-794-3030, or you can go to the website, schedule a time, find out more about the team at arhq.com. Now, guys, I found this kind of interesting, maybe even a little bit shocking. In a decade, the Census Bureau says older adults are projected to outnumber children for the first time in U.S. history, which means greater demand for health care, in-home caregiving, and assisted living facilities. But let's face it, the cost is staggering and expected to only go higher. What is the cost for these services in the area right now, and how do you help build this into the financial plans if long-term care insurance, thanks to underwriting or what have you, just isn't an option?
Well, the cost for this can be staggering, and it can be even more staggering if you don't have a plan in place. In fact, we've got a bunch of events that we're going to be covering. These three topics is, how to pay for healthcare costs pre-65, navigating the affordable healthcare. We're going to be talking about transitioning into affordable healthcare, the difference between supplemental and advantage plans, and then ultimately talking about the topic of protecting your assets from long-term care and giving you solutions without buying traditional long-term care insurance. We've got those dates up on our event at arhq.com. We'd love to have you come out. We'll walk you through this topic and give you information and how to navigate if the issue of long-term care comes up. What are some ideas? I'm going to give you 2 solutions, but I've got plenty that we talk about. There's actually 5. Number 1 is a life leverage plan. So with a life leverage plan, it gives you the ability to leverage a life insurance policy. We all know there's 2 certainties in life: death and taxes. Life leverage plan can kind of help those. Number 1 is it can help, with life insurance. If you or a loved one passes away prematurely, it can help protect your surviving spouse. It can pass on a bigger legacy to your loved one. And because of the fact that it's life insurance, if set up correctly without and having a properly named beneficiary, it avoids probate and avoids taxes. So really good. The second one is the insurance companies of America on annuity products. They have some really good riders that are associated with them that allow you to build a long-term care benefit. So you might be 65 thinking, heck, I don't need to think about this topic for 15 years, but you want to take a bucket of money and set it aside for what could be potential needs in long-term care. Some of these annuity options that are out there are fantastic, that include benefits that can be paid out in cash form for activities of daily living, and or if you never need it, offer an enhanced death benefit. So again, we'll be sharing how those work at our upcoming events that we have. All of those events are listed under our Medicare section at arhq.com. And Dave, when you look at the cost that's out there, Genworth says the average median price for assisted living is about $54,000. A private nursing home is $108,000. So when somebody needs some long-term care, the cost really can add up.
It can, and my family just has been through that. My mother-in-law, her health started to decline, and she went back and forth between the hospital and assisted living, and eventually she needed to be put in a facility that was providing ongoing health care services, and that was $7,500 a month. So you start thinking about, this is 2024, what's that going to cost in 15, 20 years from now? Because a lot of times people don't need it until they're in their 80s. My mother-in-law was 93 when she passed, so she was 92 years old. Well, you know what? It's a good thing that she invested well and she was a good saver. Her financial wherewithal was not destroyed over this, but I shudder to think what it's going to cost in 20 years for assisted living and long-term care. So you're better off making a short-term sacrifice to position some funds and put it into a vehicle that has some abilities to grow. Because with the costs only going up, you're going to need growth in those accounts to be able to cover the increases.
As time goes on, it becomes less of a possibility of long-term care needing some form of assistance and more of a probability. And, by the time that you're needing that, the underwriting, like I said earlier, may be prohibitive to you or just too expensive. There are other options out there to go ahead and address it head on. And so hopefully those what ifs won't become what nows. It's all part of the retirement team action plan, that whole encompassing scenario, that all encompassing plan for your retirement. And that starts with reaching out by going to arhq.com. You can find out more about those upcoming events that Nolan talked about on the events tab there at arhq.com, or you can give a call 419-794-3030. Once again, that's 419-794-3030. Want to thank you, as we always do, for joining us here on America's Retirement Headquarters, the home of the Retirement Guys formula at America's Medicare Associates. You have a great week ahead of you. Again, hope you enjoyed this unofficial kickoff, this Memorial Day weekend. Don't forget what it is about. Gentlemen, thank you so much for your time. And as we wrap up, I want to leave you with the final word.
Yeah, thanks again. Again, home of the free because of the brave. Thank you for all of our military that are out there. Enjoy the weekend, enjoy the family, and we look forward to talking to you soon. Just remember, when you think retirement, think America's Retirement Headquarters. It's home of the Retirement Guys formula and America's Medicare Associates.
America's Retirement Headquarters is located at 1700 Woodlands Drive in Maumee, Ohio. You can reach them by calling 419-794-3030 or online at americasretirementheadquarters.com. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Nolan Baker is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstance. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Nolan Baker, Ohio Insurance License Number 27787.